Hi, today we're going to present financial management under financial ratio analysis. Before that, I need to introduce our team member. My name is Asmira binti Muhammad Sukri, and we have Putri Nuriana Akila binti Muhammad Azam, Nur Ain Natasha binti Muhammad Razib, and Shadi bin Muhammad Zaki. First, let me explain about financial ratio analysis overview. First, type of ratio comparison. Ratio use number from financial statement, balance sheets, income statement, and cash flow. Help assess our company liquidity, growth margins, profitability, returns, and valuation. Second is trend analysis. Trend analysis, a tool of compare a company financial data over several years, convert figures into percentage for easy comparison. Example, sale from 2021 until 2023. Help investors assess the financial position for better decision making. And lastly, category of ratio. Ratio are grouped by purpose. Example, liquidity, profitability, efficiency, provide insight into financial health and operational performance. Introduction of retail. What is retail company? Retail company are company that sells goods and service directly to consumer, operate through physical store, online platform, or both. Range from small local shop to large global change. Specialize in product like clothing, electronic, grocery, or home goods. So company that we select for analysis is first Minus Holding Berhad, second 7-Eleven Malaysia Holding Berhad, third Mr. DIY Group Malaysia Berhad, and the last one is Aeon Co Berhad. Let me explain a bit about Mr. DIY Group Malaysia Berhad under overview and financial insight. So about Mr. DIY, all the people know that leading home improvement retail in Malaysia, established since 2005, offer affordable household item, tools, electronic, and more. Operates through physical store and e-commerce, focusing on value and convenience. Performance highlights based on me is liquidity, improved availability to cover short-term liability, like current ratio increased from 1.5 in 2021 to 1.98 in 2023. Leverage, reduced debt to equity ratio, 1.57 in 2021 to 1.03 in 2023, showing stronger financial stability. Efficient, better utilization of fixed asset and rapid receivable turnover. Key trend consists growth in sales and operation efficiency, reduced dividend payout ratio, retains earning for expansions. So by the conclusion, Mr. DIY remain financial stable and operational efficient. Position itself will grow in a competitive retail market.
Okay, hello, my name is Shadi, and I would like to talk on short in company's background of Minus Holding Berhad. So basically, Minus Holding Berhad is a leading convenience chain store in Malaysia with over around 460 outlets. So the store is strategically located in urban areas, includes like shopping malls, business hub, and transportation center like LRT, MRT. So the company already serves around 2.5 million customers a month. So this basically reflects is the strong presence and popularity in among us. So what's the product and service they provide? So Minus already offers us wide of range of products. So includes magazine, tobacco, snacks, drinks, and household essentials. So besides that, they also provide personal care because it's available to cater the diverse customers' needs. So besides that, also Minus also have some efforts to attain sustainability. So one of it is to install solar panels around 1.3 kilowatt, 1.3 million kilowatt of clean energy in 2023. So it's reduced almost 10% cost in energy. So also Minus Berhad also recycles around 52,000 kg of cooking oil into biofuel fuels. So this is also contribute with reduction. So to conclude this minus background check, minus holding Berhad is a major what we call it, major player in Malaysia convenience store. So with steady growth and focus on sustainability, it continues to meet the needs modern urban consumer while reducing the environmental impacts. That's all. Thank you. So now let's talk on the liquidity ratio. So I have collected all the data from annual reports from 2021 to 2023 for 3 years for minus holdings Berhad, and I have made a chart for it. So let's analyze with it in deeper. So what we can see is the decline in trends. So basically in the current ratio has been decreasing from 1.34 in 2021 to 0.85 in 2023. So this indicates that the company ability to cover short-term liabilities with the current asset they have been weakened over the years. So next is the below ideal benchmark. So the current ratio 0.85 in 2023 is below commonly accepted benchmark of 1.0 to 2.0. So it's suggesting the potential of liquidity is challenged. So with lastly, I would say for current ratio is the low current ratio in 2023 indicates that the company may face difficulty in meeting in the short term obligation without external financing or asset liquidity. So now let's talk on the quick ratio. So what we can say about so the weaker liquidity, this is because the quick ratio is consistently lower than the current ratio. So dropping from 0.81 in 2021 to 0.42 in 2023. This highlights makes the liquidity concern when the inventories are excluded. So besides that, a major is the significant drop in 2023. If you can see, the quick ratio declined from 0.69 in 2022 to 0.42 in 2023. This reflects the reduction readily available assets to cover the short-term liabilities, which might point to slower accounts receivable turnover or increase reliance on inventory. And lastly, we can conclude is the large gap between the current and quick ratio in all 3 years. It heavily relies on inventory to meet the short-term obligation, which may be risked if the inventory turns over slow down. Yeah. Okay, so next is let's talk on analysis on leverage ratio. So let's conclude with the first analysis that I have come with, that is high financial leverage. So what's that? So the debt to equity ratio remains above 1.0 in 2022 and 2023. So this indicate that the high dependence on debt financing. So this is increased financial risk, particularly in periods of low profitability. So next, we can also say on the decline of debt management capability. The times of interest earn ratio has showed a significant downward trend, indicate that the company abilities to cover interest expenses with EBIT is deteriorate. So besides that, also the navigate TEI ratio in 2022 signal that it's a bit unsustainable financial pressure. And lastly, I would urgent needs for profitability improvement. What we say with that, because while the debt of equity ratio slightly improved in 2023, but the TIE ratio remains critically low. So the company must focus to improve the EBIT through revenue growth, or what we call this cost reduction, to make sure to handle its interest obligation effectively. Next, let's talk on recommendation that I would suggest to improve. That is to reduce debt. So why we should to reduce debt? So this helps to gradually lower the company's debt levels to improve the debt of equity ratio. Maybe the second, I would recommend to boost the EBIT. Why we're gonna boost the EBIT? This helps to focus on improving operational efficiency and profitability to strengthen the times interest and ratio. So, and last recommendation that I would say to make sure that is control interest costs. Because why we need to control it? Because it's considered that refinancing the higher interest debt or negotiate lower interest rate to reduce financial burden. That's it. Thank you.
Hi, Assalamualaikum. My name is Nur Natasha binti Muhammad Hasib. So today I would like to present about Aeon Co and Berhad. Aeon is a leading retail and property management company in Malaysia. It operates as part of the Aeon Group, a Japanese retail group with a global presence. The company is known for its wide network of retail outlets and shopping malls, offering a range of goods and services to Malaysian consumers. It's established in 1984 and in Malaysia, and the headquarters in Selangor. The parent company is Aeon Group, which is a Japan company and listed on Bursa Malaysia in 1996. For their retail operations, they operate general merchandise stores, supermarkets, and specialty stores. Aeon Supermarket offer groceries, fresh produce, and household items, while the specialty store focus on fashion, beauty, and lifestyle products. While for the property management service, they manage and operate shopping malls across Malaysia, provides facilities like parking, advertising, and promotion for tenants, and regularly rejuvenates mall space to enhance customers' experience. While for the e-commerce, they launched the My Aeon To Go platform to cater to online shoppers, focusing on blending offline and online shopping experience. Extensive market presence. Aeon has a strong footprint in Malaysia with over 30 Aeon Mall and outlets strategically located in urban and suburban areas. For the brand recognition, the company is trusted household name known for quality and affordability. The sustainability commitment. Aeon is involved in various sustainability initiatives, including eco-friendly operation and community engagement. Financial for the recent year, which is 2021, 2022, and 2023, Aeon has shown resilience in overcoming challenge like COVID-19 pandemic through cost management, strategic investment, and digital transformation. Its revenue streams are well diversified between retail, sales, and property management. Aeon aims to be a lifestyle innovator, continuously adapting to changing consumer needs. The company focuses on enhancing its digital presence, expanding its product range and service, strengthening sustainability efforts, and Aeon ability to innovate and adapt position it as a key player in Malaysia's retail and property management sector. So let's move to the ratio trends. So we start with the liquidity ratio. For the current ratio, we can see that there is an increase slightly from 0.71 to 0.76. And for the quick ratio, it is also improved from 0.67 to 0.72. And for the leverage ratio, debt to equity ratio, it is remains steady around 0.42 across the year. And for the time interest earned TIE, it is declined from 13.1 to 11.7, which is slightly reduced coverage of interest payment over time. And for the activity ratio, the average collection period, we can see it is increased from 20.1 days to 21.1 days. And for the fixed asset turnover, it is slightly improved from 1.14 to 1.17. And for the profitability ratio, for the gross profit margin, we can see it is increased from 16.5% to 17.1%, which is reflecting improved cost management. And for the return on asset ROA, it is also increased from 1.45% to 1.5%. And lastly, for the market ratio, it is for the dividend payout ratio, you can see it is remains stable at around 49 to 50%. And for the PE ratio, it is increased slightly from 0.23 to 0.24. And for the conclusion, we can say that liquidity ratio for the current and quick ratio, it is a gradual improvement in liquidity each year. And for the leverage ratio, debt to equity ratio and TIE, it is show a stable leverage but slight decline in interest coverage. And for the activity ratio, average collection period and fixed asset turnover, we can see that it is a slight slowdown in receivable collection but improved asset utilizations. And for the profitability ratio, gross profit margin and ROA, it is a steady improvement in profitability. And lastly, for the market ratio, which is a dividend payout ratio and PE ratio, it is consistent shareholder returns and stable market valuation.
Okay, next let's compare My News Holding Berhad with the others competitor that relates with the industry. So let's see what I analyzed based on the chart that I've presented you. So let's talk about the liquidity. So in 2021, My News had the quickest ratio among them, 0.81. So it means that it was the best position for cover short-term obligation and liquid assets. Meanwhile, the weakest liquidity for 2021 is 7-Eleven. This is because they have the lowest quick ratio around 0.43. So this makes their liquidity weaker in 2021. So next, let's talk on the improving and decline trends between them. So one of it is Aeon and 7-Eleven constantly improve their quick ratio over the years. So what the improvement is like, Aeon increased from 0.67 from 2021 increased to 0.72, so it slightly increased. And then also 7-Eleven almost double it, almost 2 amount from the previous year, that is 0.43 from 2021, and then it almost double it 0.83 2022. So this is marking the strongest recovery from 7-Eleven. So in contrast, MyNews faced a big step decline from 0.81 in 2021 to 0.33. So the declining is a bit, we would say a bit difference. So therefore, before slightly and then after the declining, it's slightly recover after the year is 0.42 in 2022. So next, let's on Mr. DIY show the ability but stay relatively still low, fluctuate between 0.45 to 0.49. So it's a bit ups and downs between them. So next, let's talk on their current leaders in 2023. So 7-Eleven leads with a quick ratio 0.84, showing the best liquidity position for the latest year. So but for MyNews Holding Berhad is a bit lag behind with the lowest quick ratio 0.42, despite slightly improved. So overall, we can say that AEON and 7-Eleven shows the strongest among consistent improving in managing their liquidity. Indicates that the effectiveness of financial management. So meanwhile, MyNews sadly face challenges that will significantly declines in the liquidity and possibly reflecting their operation or their financial strength. And lastly, we can say on Mr. DIY, they still remain stable but constantly has lower ratio among the competitors. So they still need to improve actually, which may possess long-term risk if ability increase unexpectedly. Yes.
7-Eleven Sdn Bhd is the leading convenience store operating in Malaysia. Established in 1984 with its first store in Kuala Lumpur, the company has since expanded into a nationwide network of thousands of outlets, providing a wide range of products including snack, beverage, groceries and ready-to-eat meals, and personal care items, as well as value-added service like bill payments, parcel collection and mobile reloads. Headquarters was in Kuala Lumpur. Is committed to offering convenient quality and innovation to meet customer needs 24 hours. As a recognized leader in the retail convenience sector, the company continues to grow and innovate, cementing its position as a trusted brand in Malaysia. We move to the comparison between 3 years for the 7-Elevens. Over the 3 years, the company demonstrated improvement in its liquidity as evident by the increasing current ratio from 0.89 in 2021 to 1.16 in 2023, and a quick ratio from 0.43 to 0.484 over the same periods. These three indicate a growing ability to cover short-term liabilities with the short-term and liquid assets, reflecting stronger financial health. However, while the quick ratio has improved significantly, it still falls short of the ideal benchmark of 1.0. In terms of leverage, the debt-to-equity ratio initially rose to 1.79 in 2022, but moderated to 1.06 in 2023, suggesting a slightly reduced reliance on debts. Nevertheless, the company remains highly leveraged, and its declining time interest earnings ratio in 2023, falling to 1.42, signal weak ability to meet interest obligation, likely due to higher costs or reduced operation income. We move to the average collection period, fixed asset turnover, gross profit margin, and return on assets. Average collection period consistently improved, dropping from 21.38 days in 2021 to 16.38 days in 2022. This demonstrates faster receivable collection, enhanced cash flow efficiency and liquidity.
However, the fixed asset turnover ratio, which measure the efficiency of utilizing fixed asset to generate sales, peaked at 10.41 in 2022 before declining to 6.96 in 2023. This suggests a drop in asset utilization efficiency, possibly due to reduced sales volume or over-investment in fixed assets. On the profitability in front, the company achieved steady improvement in its gross profit margins, increased from 27.02% in 2021 to 31.11% in 2023. This indicates better management of productions and sales cost relative to revenue. The return on asset also surged from 2.60% in 2021 to an exceptional 15.84% in 2023, reflecting significant gains in the company's abilities to generate profit from its assets. This trend suggests strong profitability growth, and also the decline asset turnover highlight the need to optimize asset utilization to sustain long-term performance. We move to the dividend payout ratio, and the price to earning ratio increased from 30% in 2021 to 34.73% 2022, then decreased to 22.90% in 2023. The company reduced dividend distribution in 2023, possibly to reinvest earnings to growth or to conserve cash. Price to earning ratio dropped from 63.63 in the 2021 to 10.60 in 2003, with no value report for 2022. The sharp decline suggests the stock is no more attractively valued relative to earnings. Through the lack of data for 2022 raise questions. Last but not least, for the conclusions, liquidity improved. Ratio highlights stronger short-term financial stability, but leverage a slight reduction in the debt to equity ratio in managing leverage, but weak interest coverage risk concern about the company ability. Move to the activity. While cash flow efficiency improved with the faster receivable collections, but decline of fixed asset utilization suggests challenge in the generating sales or potential efficiencies in assets and investments. Move to the market performance. The reduction in dividend payout, the lower PE ratio indicate a shift in prioritize toward growth and a potentially undervalued stock warranting attention from investors.
For the conclusion, what we can see from the graph, for the liquidity, Mr. DIY leads with the highest current ratio, 1.98, while Aeon and MyNews struggle to exceed 1.0. Leverage, Aeon shows the lowest debt to equity ratio, which is 0.42, indicating a balanced financial structure. For the activity, Mr. DIY excel with the shortest average collection period, which is 0.62 days, and strong fixed asset turnover is 5.32. And for the profitability, Mr. DIY demonstrates the highest gross profit margin, which is 44%, while 7-Eleven leads in return on asset is 15.84%. For the dividends, Aeon maintains the highest dividends payout ratio, which is 50%, reflecting consistent shareholder return. Each company excels in different areas. Mr. DIY leads in liquidity, activity, and profitability, which is gross profit margin. Aeon demonstrates financial stability through low leverage and high dividends. And 7-Eleven excels in asset profitability. These insights suggest that Aeon prioritizes financial stability and shareholder returns, while Mr. DIY focuses on operational efficiency and profitability. That's all from our group. Thank you.